Good evening, everyone. Welcome to the Let's Trade Live. This is Wayne, Head of Research and Education. On behalf of Fullerton Markets, I warmly welcome everyone to the webinar. As usual, the webinar will be divided into three segments. The first segment will look at the past event that has happened in the last 1 week. Then we'll move on to the second segment. We'll look at the upcoming calendar to see if there are any trading opportunities. And finally, the last segment will move on to the charts. I'll take on the requests from all of you. So very quickly, for last week, of course, the key data, or rather the market has been watching out for, is basically the US data, namely the GDP, their ADP non-farm payroll, and their official non-farm payroll. So the GDP, prelim GDP, is adjusted upwards from 3% as market forecast to 3.2%. So it was a very positive number. And for the ADP non-farm payroll, it also came in at 216,000. Close to more than 50,000 more than the forecast. So the numbers was really positive. So much so that immediately the market priced in a 100% rate hike. So it was close to 100%. So last week, basically, it is almost confirmed, or the market is almost confirming there will be a rate hike in December. And of course, after the two data, market is actually expecting a very good number from non-farm payroll. So the bar was being raised higher. So ultimately on Friday, the data is considered as not bad, but because the expectation was really high, so it came in as a slight disappointment. So the data came in at 178K, which is quite good if you ask me. And unemployment rate actually fell from 4.9% to 4.6%. The only disappointment is actually their average earnings, which is their wage growth. It dropped by 0.1%. So all in all, it is considered a good non-farm payroll, but because, as I mentioned, the expectation was very high, so it became a slight disappointment. But nonetheless, market is still maintaining a rate hike expectation in 2 weeks' time, or next week. So the only question is not a question whether there will be a rate hike in December anymore. Of course, it's waiting for the official announcement to be made. The market is looking out for in next FOMC would be for the Fed, or rather Janet Yellen, to give some clue as to how are they going to move forward with the rest of the rate hike, or rather the next rate hike. Will it be somewhere in the first half of 2017 or later part of 2017? So this is what the market will be looking out for next week. So that's so much for US data. And then of course the next event that happened is basically the Opec meeting. So the finalized deal that was agreed after the meeting was actually a very good deal, because as we have observed how the OPEC and the non-OPEC nations has been going back and forth throughout the entire year, market is actually a bit skeptical about the deal that is going to be released after the meeting. And of course, at the end of the meeting, the OPEC countries agreed to cut their production by 1.2 million barrels a day. And what surprised us, or rather surprised me, is that the OPEC actually agreed to a special exemption for Iran. So Iran can still increase its production, whereas the rest of the OPEC countries will cut their production, as you can see from this summary chart from Bloomberg. So of course that was one of the potential hurdle, because throughout the year there has been a disagreement between Saudi, Iran and things, and people are skeptical about the oil production deal, because most people would not think that Iran, after their 40-year-old sanction has been lifted, they would agree to a production cut. They would be aggressively so-called wanted or aiming to get their market share back. So this is really a surprise to us. So I believe to the market as well, they will be cheering, as in the OPEC is really coming together to do something. And of course, Russia also committed to cut as much as 300,000 barrels a day. So this is all in all the good news. That's why for last week we have seen the WTI celebrated, shot as high as $52 a barrel towards end of last week. So last known I checked at the chart, it has actually crossed above $52. So later when we go to the charts, if some of you request to take a look at oil, we can definitely look at it. Of course, over the weekend, as mentioned in my previous webinar, this is the event to look out for, the Italy Referendum. So first thing, on Monday today, their Prime Minister actually quit as promised, because he said if he loses the referendum, he would quit. So 60% of Italians actually voted against his proposal. So over here is a picture from Bloomberg as well, showing him giving a press conference. So now, as you can see, it is a big political uncertainty. The Prime Minister of a country has quit, and there's no successor yet. And Italy being the third largest economy in Eurozone, that is something definitely the market will be looking out for. And of course, the next thing that concerns the market is, what if, when are they going to install their new Prime Minister, or is it going to be an early election? And will it be a pro-exit Euro kind of party winning the election and things like that? So the next uncertainty actually looming Italy is election, and whether would it be a party that is pro-exit Euro kind of party being elected. Because if that is so, the next possible thing that could happen is Italy exit Euro referendum. So market is looking, of course, quite a fair bit ahead. But when it comes to fear, it is kind of quite scary, even though it's a slight chance. So as mentioned in the past webinar as well, it is not only Italy. Next year, France is going to hold their French presidential election, and there is a possibility that a party that is pro-Frexit that will get elected. So of course, how possible is that? It is still way too early to tell. But as how market would react to fear, as long as it's a slight, even a 1% chance of it happening, market will start to sell first and think later. So this is the two key political so-called challenge that is pressuring the euro for now until next year definitely. So it will be something to watch out for. The Frexit and the Itzit, if you call it Italy exit. So anyway, this is just for us to take note for now. And of course, with all this possible concern in the back of investors and the traders' mind, it is not difficult to tell that the euro should be is likely to be under pressure. So even if there's a short-term rally on the euro, it could be really a short-term rally. So in the mid to long term, especially next year, I think there will be quite a pressure on the euro depending on the development in these two countries. Okay, let's move on to the second segment. We'll look at the calendar for this week. So after the non-farm payroll of last week, this week basically market is not really looking out for any US data, even though there are some US data like the consumer sentiment, the ISM, non-manufacturing PMI. But just like most analysts out there, we are not expecting market to react much to this news. Rather, market is likely to wait for next week's FOMC. So US dollar should be quite on a neutral side this week. A lot of movement will be determined by other factors. So of course the first one would be on Tuesday, GMT plus 8, 11:30 in the morning. So this is a Reserve Bank of Australia interest rate decision. So the interest rate currently is 1.5%. So as a suggestion, this is trading against any, in preparation for any surprises. So market is not expecting RBA to cut interest rate, obviously. So they are expecting to maintain their interest rate for now. Especially their data has been showing improvement, and China also showing sign of recovery as well. So there are good news surrounding Australia and his largest trading partner. So we don't see any reason of them cutting interest rate. But you never know. Sometimes central bankers like to surprise the market for whatever reason, and they will act first and explain later in their statement. So as a trader, one way to take advantage of any surprise is to a suggestion like this: pending short Aussie dollar in the event RBA cut interest rate. So at the point of announcement, if they really announce interest rate cut, it should take your pending short order along for a nice profit. However, if they hold their interest rate, then it is time for you to delete the pending order in the shortest possible time. So this is the trade suggestion. The next one will be on Wednesday night, 2300 hours, GMT plus 8 time zone. So this is a Bank of Canada interest rate decision. Again, the market consensus is that they will hold their interest rate unchanged at 0.5%. So of course, you never know. In the event Bank of Canada surprise the market again for whatever reason and cut their interest rate, this would be a suggestion, a pending long on dollar cap in the event if Bank of Canada cut interest rate. For now, the expectation of Bank of Canada is that they should or they are likely to maintain their optimistic outlook. After all, especially OPEC has announced a deal to cut the supply. That should give the oil price a quite a good boost, or at least a support at around the $50 a barrel region. So this definitely will help Canada, as Canada exports a majority of the oil that they pump. So with all this good news, it is expected that Bank of Canada to give a rather optimistic view and optimistic statement. So on Thursday will be another central bank making announcement. So this week we are looking at 3 major central banks making their interest rate announcement. So on Thursday, 20:45 hours, it will be ECB making their interest rate announcement. Again, market is not expecting much changes from them. They should maintain their interest rate at 0%. So to prepare for the surprise, it will be a suggestion to do a pending short on euro dollar in the event ECB cut interest rate to negative interest rate. So for ECB, the euro is under pressure because of the key political event in Italy and the upcoming one for France. So both are actually having a possibility of exiting euro. So that's the main concern in the traders and investors' head. The second and the third largest economy in Europe. So as long as they have a slight chance of it happening, I think market will continue to look for a good price to sell the euro. So euro is likely to remain weak. So it is good for having a weak currency. Is actually there's some good plus point to it as well. So it should help the export in Eurozone, so that the goods and the services remain competitive. So for now, we do not expect ECB to make any changes to their monetary policy. They should be maintaining a neutral so-called bias. Their data is not that bad after all. So the only interesting thing to look out for is Mario Draghi's statement and press conference. If ever anyone asks him about his view on the possible Frexit and Exit, it will be interesting to see what his reply would be. So there will be something to look out for after their press conference and statement. What he has to say for next year especially, that will give us some clue what to look out for in the kind of policy to expect from ECB. So that's about the 3 key news and suggestion for this week. So finally, before we move on to the charts, a quick commercial break. This will be the accelerator offered by Fullerton Markets. In case some of you have not taken advantage of it, please do not miss out this bonus. It is the most popular bonus by far. So check out fullertonmarkets.com/promotions for the full details and the terms and conditions. And to take advantage of this bonus, of course, just proceed to open an account with Fullerton Markets. Of course, in the event you have any questions regarding the promotions and the opening and funding of your account, feel free to approach our online live chat. Just go to our website, fullertonmarkets.com. On the right hand side of the website, you will be able to access our live chat, and our friendly support staff will be able to assist you 24 hours a day, 5 days a week. So as long as the forex market is open, our live chat will be available to assist you. So next, we're moving on to the third and final segment. We'll go on to the charts, and feel free to type in any questions that you may have, and also the symbols and the time frame that you want me to look at. Okay, as the request is coming in, I'll take on the first question. Will you suggest us to long dollar CAD if interest rate remain at 0.5%? I would not advise you to enter any trade if the interest rate remain at 0.5%. Reason is most likely the market will move on to look at what Bank of Canada has to say in their statement. So if they choose to remain at 0.5%, which is what the market is expected it to happen, meaning to say it is unlikely to have much movement since it is a expected kind of decision. So I would not suggest you to go long or short on dollar CAD when they remain their interest rate at 0.5%. Rather, if you want to, you can log on to Bloomberg TV to listen to what Bank of Canada have to say. But it will be quite tricky for trader if you are not experienced enough to decipher their language. So hope that answer your question. So while you are typing in the request and the time frame, I'll go through the charts that we have gone through last week. The first chart, of course, is Aussie dollar. Aussie dollar, as you can see, these were the comments. So I have given the red dotted line is the time of the webinar. So the first blue box over here is actually the suggested entry price, and the box on top is the suggested stop loss, and the box below suggested first target. So as you can see, the price actually went to the suggested entry price, and it retraced higher, but the resistance hold on well, and market eventually went down. So of course, if you have followed this suggested trade, and it would have hit our first target. So at the first target, I have also mentioned last week, you can either close off a partial of your position and shift the stop loss of the remaining position to your entry price. So if you have done that, you have managed to pocket some profit. Of course, the other option is once the market hits the first target, you close off all your position. So in this example, if you have done that, you have made slightly more profit. So this is Aussie dollar chart that we have looked at. The Aussie dollar daily chart basically is just saying that I'm expecting good numbers from GDP, ADP non-farm payroll, and the actual non-farm payroll. So if so I mentioned that if it is good data, market may head towards 0.73, which is where the blue label is, in the next 2 weeks. So next 2 weeks, this comments was being mentioned last week. So next 2 weeks means last week and this week, heading up to FOMC. The next chart we actually looked at is pound yen. Quite a disappointing chart, so I'm sure some of you know what's the reason. So this was the red dotted line is the time of the webinar. So I mentioned a possible entry after bullish engulfing pattern, and the pattern has formed immediately after the webinar. and gave us the entry to go long. And interestingly, the price just retraced down to our suggested stop loss and then move in our favor. Okay, so these are some of the things or scenarios that could happen to us trader once in a while. So I've been trading for a few years, quite a number of years, and this is definitely not the first time I've encountered this kind of scenario. Trust me, after you have entered thousands of trades, out of that few thousands of trades, definitely you will see some of such trade whereby prices move and just touch your stop loss and then move in your direction. Okay, you will definitely encounter a few of such trade. And a lesson over here just to highlight, please do not change your rules just because of these few trades. Of course, if you have encountered like out of 10 trades, maybe 2 trades is happening like that. After you enter, prices just hit your stop loss and then go in your direction. Let's say out of 10 trades, you have like 1 or 2 trades that is that you are facing this scenario, then that will be the time for you to review your trading rules to see whether you have set the criteria of you setting your stop loss is appropriate or not. But if it is like 1 out of 100 trades, please don't bother to change your rules. So of course, there's no point hopping over it. It just happened. But as the saying goes, usually a trader will learn more from a losing trade, especially such a losing trade. So it is always good to keep a journal of what you have done, and then when you want to review to see whether there's any way to improve your trades, there's some record to do it. So let's take this trade as an example to see whether there is any learning point that we can take out from this trade. So if you have recorded, this trade is decided on a H1 chart, and this is the trend line that was drawn last week with all the reference point. And over here it is when the market is retracing towards the trend line again, where we decide that probably the market would respect the trend line and continue upwards. So of course, market has shown us that it has a slight false break over here that broke the trend line before going upwards. So this is the H1 chart. So let me switch to a higher time frame to let you see a different perspective. So this is, I shall move the words away. Okay, so this was the chart. And for those of you who are aware of area of conversion, this would be it. You will notice the prior resistance over here has become the support eventually. So this is a typical conversion region in an uptrend. So usually in an uptrend, it's not difficult to find such a conversion region. So just by looking at this chart, a learning point or learning takeaway for me as a trader would be, if a future scenario happen on a H1 chart like this, whereby there's a trend line and I'm expecting price to respect the trend line, it could be a better option to cross check with a higher time frame to see whether there is a potential area of conversion. So this is one learning point that I could take away from this trade. So if the price of the H1 entry price is so near to the conversion region, then possibly instead of setting my stop loss, as you can see over here, exactly near the conversion region, one possible option is to set it lower, slightly lower below the conversion region instead. So just to highlight, this is how I as a trader review my trade to see whether there is any way to improve it. So this is just to a learning so-called demonstration, so that in future when you review your own trades, you can do a similar adjustment as well to your trading rules. Okay, so this is the pound yen chart that we have looked at, and the last chart that we have looked at last week is gold. Okay, again the same fundamental reason, expecting good data out from GDP, non-farm payroll. So I mentioned that I'm on a bearish bias for gold. So the immediate support resistance I have marked over here. So the red dotted line again is the time of the webinar. So I mentioned the blue box over here is suggested entry price, and of course the suggested targets, as you can see over here, there's two blue box, one slightly above 1182 and the other slightly above 1178, two suggested targets. And for this one, the suggested stop loss is way above the resistance of 1196, so it is placed close to the 1200 level. So if you have followed this suggestion, so I believe at least you would have hit your first target. So of course, if some of you would have hold the trade, you would have easily hit your second target. And if some of you have trailed your stop, maybe you have taken further down as well. So this is the gold chart that we have looked at. Not too bad for all the charts that we have looked at last week. So hopefully some of you have grabbed some pips from all these suggestions. Okay, now move on to the current chart and look for opportunities for this week. Let me look at the requests. The first one will be a Kiwi Dollar. Okay, let's look at a Kiwi Dollar. Of course, Kiwi Dollar, there's not a lot of major news this week. The only one to look out for is the GDT, Global Dairy Trading Price, Global Dairy Trading Index. Excuse me. That would be the index to measure the dairy product prices. So the prices has been rising for the last two release. I think it is, if I recall correctly, it was in the region of about 11%, and the last one was about 4.5%. So of course, if the dairy products continue to increase, it is a good news for the Kiwi. But unless there's a big increase or a big drop in price, I personally don't expect much impact on the Kiwi. So if price continue to rise for 2%, 3%, the impact on the Kiwi dollar is marginal. So this Kiwi dollar H4 chart, if you see the chart now, the request is for me to look at H1, H4, so I'll just toggle between the two and take a look. So this is a H1 chart. The trend is not that clear, so it is more in so-called sideways manner. So with no key data out from New Zealand plus US dollar, I think the market will be waiting for next week FOMC instead. So I expect the Kiwi dollar to continue in a sideways manner. So that's my comment. I'll just put it over here. Of course, this is what I expect the Kiwi dollar to move. But as a trader, we always trade based on reaction. So we react to the market. So let the market tell us where it is heading, and then we shall make our trading decisions accordingly. So the comment over there, if you ask me, is just for show. It is a form of prediction. So again, for traders, we don't predict, we react. So this is the sort of conversion region as well that I have marked over here. Quite a nice round number, 0.7080. Of course, nothing is perfect in the market. So some of you may ask me, why is there a false breakout over here? It's supposed to be a support. There's definitely a reason for false breakout. So anyway, so you as a trader, there's never a scenario whereby you find a market that's so perfect. But why do I see, some of you may ask, why do I see this as a conversion region? There are enough areas where price rejects. That means price failed to go beyond it for me to identify as possible area of conversion. Okay, as you can see the areas that I have marked, let me zoom in so that it's clearer. As you can see, all these shadows, about like 5 to 10 candles with the shadows failing to cross this price level around 0.7080. And then over here, there's easily another 10 candles that failed to go above it. Over here, you can see a few candles that got rejected before breaking to go higher. And over here, also another 4 candles that failed to go lower. But eventually, it closed lower, but it was a false breakout. And then after that, come back another 2 candles that sort of face a support over here. So that's why there are enough candlesticks in this region, just by looking at it, for me to identify this as a possible conversion region. And when it is a conversion region, to me it is also a region of decision making. So meaning to say, if since this is a decision making region, if there's any candle that close below it, somewhere here, maybe it is a clue to tell us that market has made a decision to go downwards. If candle closes above the region, then possibly it is a clue that market may have made the decision to go higher. So this is my so-called view on Kiwi Dollar. So for this week, I do expect Kiwi Dollar to continue in a sideways motion, and as I mentioned earlier, market has already priced in 100% rate hike next week. So having said that, it means that at this moment I don't see any reason for dollar to strengthen unless there is a further speculation that after December rate hike, the next rate hike will be maybe in the first quarter of 2017. At this moment, that would be the one of the reason that could possibly push dollar stronger. And then for Kiwi Dollar to go lower, the other possibility is weak Kiwi. And based on the current situation, one of the possibility would be the GDT having very bad figures. So that means the global dairy products prices has dropped drastically. That will be an impact on New Zealand and eventually the Kiwi Dollar. So one of the possibility is a bad GDT number, causing it for the Kiwi Dollar to drop below. So of course, on the other hand, a good GDT number possibly would see the Kiwi Dollar finding support over here at 0.7080 to head upwards. So over here are suggested entries. Okay, these are the suggested entries. Oops, wait. Okay. The potential so-called target over here. I like to put the immediate target with reference to potential support. So you notice for the short suggestion, the target is slightly lower, all the way to the whole number of 0.70. Okay, 0.70 is here for your reference. That is the first target, but of course, if at the point of price hitting first target and you have reasons to suspect that Kiwi Dollar may fall further, then you can always make the choice to do a trailing stop or to take partial profit only. Then of course for long, the first target is slightly nearer because referencing the last high, that will be around 7140 7140 thereabout. That will be the first target. So if price reach that target, at that point in time, if you assess there are reasons to believe you can go higher, then possibly you could take partial profit and apply trailing stop to it. But if at the point you have reasons to believe that there is the limit to how far Kiwi Dollar may go, then you can make the choice of closing out your positions or position totally. So your next question could be, how do I know what are the reasons that could possibly move the Kiwi Dollar higher or lower? So of course, that one will rely on news, central bank policies at that point in time. So of course, if you have no inclination of whatsoever, then you can always choose to close out all your positions and then you look forward to the next trade. So this Kiwi Dollar on H4 chart. Okay, just in case there may be a minor so-called support over here, which is a bit tricky. If you short, it is a short distance away only, which is at 7040 thereabout. So you notice from your potential entry to that possible conversion region, again there is about 25 pips. Considered near because we are trading the H4 chart. For if you are trading the 1 minute and 5 minute chart, of course 25 pips is a lot. So it's a different perspective. So on a H4 chart, 25 pips is considered near. So what you can do is another suggestion, since if you agree with me that 0.7040 is the area of conversion also, what you can do after you enter, if the market give you a signal to enter for short, and as the price move and towards the 0.7040, even if it moves only 26 pips or 25 pips or so, what you can do is to protect your position first. Since it's only 25 pips for your position on a H4, closing out your position may not make much profit anyway. So suggestion would be you just protect your position. Shift your stop loss to entry price. So in worst case scenario, if this 0.7040 region really turns out to become a support and the price reverse to go up, you don't lose a single cent. But of course, if it doesn't go up and price really moved lower, then you did not miss out the profit. So the 0.7040 could be the first milestone for any short trade to consider, for you to consider protecting your position first. Good. The next symbol request will be Euro Dollar, H1 and H4. Euro Dollar. Okay, good. Let's look at Euro Dollar. It has a gap today at the opening, but last look at the chart, the gap actually closed up. Okay, let me put the vertical line first. Okay, this is. Let's look at this is actually the daily chart. Okay, let's look at H4 chart, euro dollar. So you have noticed that the price gap, I zoom in so it's easier for you to see. As you can see, the price gap downwards from last Friday's closing. It was about close to 60 pips gap, and immediately move further down another 100 pips in the first 4 hours before retracing upwards. So now price actually closed back the gap. So let's look at the chart, H1 chart, and see. Okay, this is the H1 chart. Quite a mess. No obvious direction. It is going up, down, up, down. The trend is also not clear, especially on a H1 chart. All in all, a summary just by looking at this chart, euro dollar is volatility is increasing, but it is still in a sideways so-called motion. So let's look at H4. H4 could be a more interesting chart to trade. So over here, market is hitting its resistance. Okay, maybe looking to close above it as well. $1.0690. So over here, the support is around 0.105, 1.053. Might as well make it a round number. 1.0530. Of course, on a higher time frame, if you have looked at the euro dollar, 1.05 is quite a key support at this moment. So again, for dollar to strengthen, the market will need a reason to buy the dollar again. So that would be a FOMC again. But for euro, why does it retrace upwards and things like that? Okay, this is of course it only happened in the last few hours. So unless I go to the market and start to hunt for the news, then of course I'll be able to find a reason for it. Most importantly, for euro dollar, after the Renzi, Prime Minister Renzi resigned, maybe it is market after a few hours or after half a day of considering, they may be thinking, oh, I have overreacted. So even if Renzi resign, the chances of Italy exiting euro is very, very low. It is unreasonable to price in that kind of impact. So it is well possible to be that kind of reason. As you can see, prices retrace back up to cover whatever euro has lost in the opening day or opening hours of this week. So of course, for this week, euro dollar, the ECB interest rate and press conference on Thursday will have a big impact on euro dollar. So as of now, I do expect euro dollars to still so-called be trapped within this range, 1.0690 to 1.0530. That will be 100 over pips kind of range. Of course, if price chose to hit higher to close above 1.0690, okay, if price chose to close higher, okay, so this is about 10 pips above the 1.07 level. Thereabout, plus minus. Okay, 10720 plus minus, that would be if price close around that price, then for a short-term trade from now until ECB, possibly you could consider to go long, because price broke higher than 1.0690. But if you have reason to believe that this rally is not going to hold, because after all the concern is still real and uncertainty is still looming, then possibly this could be a false breakout. So it depends on your opinion, whether you think that euro dollar is going to rally ahead of ECB, or this could be possibly a false breakout before prices retrace below. So of course, if you believe that ECB or Mario Draghi is going to say something that will boost the euro, then you could apply a breakout strategy to take a long trade. But if you are on the camp to believe this could be potentially a false breakout, then you could apply a false breakout strategy to take the trade back into the range. So of course, I know your next question, after I presented the two camps, you would be interested to know which camp do I belong. So if you ask me, I belong to the bearish camp on euro dollar. So even though if price close above, I will still maintain I'll stay out. So that is my bias for euro dollar. And my reason is simple. This will be in the head of a trader. So if the euro dollar continue to go higher, it is as if they are in a way pricing out the effect of Fed rate hike next week. So if there is really a rate hike next week, then possibly euro dollar will have some room to move. And of course, the looming political uncertainties, it will always be at the back of the head of a trader. So whenever they would look to buy euro, possibly that would be the biggest concern or biggest reason stopping them from doing so. So these are my two reasons why I'm still on a bearish bias on euro dollar. So having said that, it doesn't mean I will short now. I will wait for the market to tell me when is a good time to short. So if the price really close above 1.0690, I will not short yet. So I'll wait for it to close back below. So if the price really go up, I'll wait for it, a candle to close back below 1.0690, close back into this region before taking a short. Okay, so that's my comments for euro dollar. So of course, if you are someone who say, oh, Wayne's bias is actually not so good. So when Wayne said that he has a bearish bias, chances that euro dollar will go up. So if you have that kind of observation after listening to me for a period of time, then you may be the one who chose to go long on euro dollar when price close above 1.0690. Okay, so let's move on to the next currency pair. On my request would be euro yen H1. Okay, let's look at euro yen. H1. Okay, let me put the vertical line. Yes, over here. Euro yen has a similar move for the week opening, meaning today. Gap downwards, and a few hours later close back the gap and head higher. So that's euro yen. The request is to look at H1. Okay, so this is H1. A bit of volatility over here. Of course, if I cover up that part, you will notice, euro yen very much in an uptrend. And it is quite a nice uptrend on H1 chart. But a big political event have caused the chart to have some weird movement. Weird as in compared to the chart prior to it. So it makes the chart looks weird. This is common, especially after a big event that has a major impact on the market. And because of this, usually it will sort of mess up the technicals a bit for the chartists or the or traders that rely on heavily on technical analysis. Whatever happened in the since the start of this week, and a few hours after that, it could mess up the technical analysis. So of course, one way is to discount whatever has happened in the past few hours since the opening. So you can interpret this as, oh yes, the market priced in a so-called possible exit, but later realized that it is possible but not probable. That's why markets try to price out again. And maybe later view that the resignation of Italy Prime Minister could be a good thing for Italy, and you see the price going higher. Of course, what I'm saying in the last 5 minutes is just pure speculation. Whether it is the true reason of euro dollar strengthening or not, we really do not know. Anyone can put any reason to it because it has happened. So what is important to us as a trader at this point in time is euro yen has made a new high. The last high is over here, which is around 121.85 plus minus. That is the so-called last high. And now the price has gone even higher to 12250. So when price has made a new high, it could go even higher. So that is the definition of a trend. So since the market is telling us that it wants to go higher, then to me the appropriate way is to trade along that direction. So it is a very sharp move in the last 4-5 hours. So there was a pause over here. Okay, let me zoom in. There was a pause over here. After 2 long bull candle, a pause, followed by another 2 long bull candle. And this bear candle is not as small as this, but this could well be a profit-taking kind of move before price move higher. But price may also choose to retrace more before it goes higher as well. So for the aggressive way of trading, aggressive way of trading, if the current candle closes above the opening price of the bear candle, basically it's around the blue region over here, it is about 122.45 plus minus like a few pips is fine. Plus minus 2-3 pips is fine. So if the candle close around 122.45, aggressive trade, this would be a consider aggressive aggressive long immediately after a bear candle pause. The next push upwards, as long as it's confirmed by a close around 122.45, possible to take a long. So this would be considered an aggressive long. Of course, the other possibility is for the price to retrace back to the last pause over here, which is around 121.40. So once it retraces to that level, that is the decision region. I'm waiting for it to get out from the region before I will take a long trade. Okay, so this would be two possibilities for you to consider. And the second suggestion below is consider a conservative long. Okay, in case some of you feel that aggressive is no good, conservative looks safer, let me define. Aggressive means you are buying at a higher price. Conservative means you are buying at a lower price. So that is my definition of aggressive and conservative. So it doesn't mean, oh, to be conservative is good or to be aggressive is better. There's no such definition of, or rather there's no such clear advantage of aggressive over conservative and vice versa. So you only choose whichever that you feel more comfortable. Definitely some traders are more inclined towards aggressive way of trading, whereas there are also another group of traders who are more or preferred the conservative way of trading. Okay, so this is two suggestions for you to consider. Euro, yen. Okay, the next chart, please. Okay, before I look at the next chart, I can see some question coming in. What kind of time frame does swing trader with a full-time job uses? How often do I check the prices? Good question. So usually for swing trader, typically they prefer to trade the H4 to daily chart, H4 or daily, occasionally hourly chart as well. So typically these three time frame, H1, H4, or daily, or even daily, yes. So based on these three different time frame, if you are trading the daily chart, of course you just look at it once a day, because one day one candle. But if you are trading the H4, it is also about once a day or even twice a day, because each candle is only 4 hours, so the trade may not happen after 2-3 candles, and 2-3 candles is easily 12 hours already. So even when you are trading the H4 chart, typically one day you are looking or checking the price maybe around 3 times a day. But if you are trading the H1 chart, then obviously maybe you check the chart every like 3 hours, 2-3 hours once. So one day maybe you will look at the chart for 6 to 8 times to monitor the market. So if you have a full-time job and you can't afford to look at the chart so often, then possibly you could consider one of these time frame that I have mentioned. Okay, so let's back to the request. The next request, yes, will be go on H1. Wow, that is go on H1 would be pretty volatile. Let's look at go for H1. Okay, let me clear out all these previous markings. Okay, this is go in a H1 chart. It has sort of form a support over here. About 1162 on a H1 chart. But before I proceed, let me just scan through the higher time frame to see if there are any prominent support or resistance. Okay, this is the daily chart. Not much maybe on a weekly chart the price is in the conversion region. Okay, for discussion purpose. Okay, as you can see, the price sort of got rejected over here, and then once it broke through, hit the resistance again, broke through, now is heading back to around the 1162 level. But this is a weekly, the conversion region on weekly chart, meaning the thickness of it is quite significant. What do I mean by the thickness of it? So assuming this thickness is the so-called conversion region, and this region is about 2000 points in difference. That's quite a big region if you scale it down to a daily H1 chart to trade. H1 chart, if you want to take any trade within 2000 points, you can easily get in and out. So meaning to say that this region, although we know price is near that region, but it may not be helpful for us to decide our trade in a H1 chart. Okay, so that means that after I scan through all the time frame, there is nothing worth taking note of. There's no support resistance to take note of. So back to H1 chart. So this would be the one, the immediate support over here, which is 1162. And for resistance, for gold, especially in a lower time frame, it is even harder to find a very perfect chart, or rather perfect support resistance, because of the volatility. It tends to have a lot of shadows in the candles. But nonetheless, we can do our best to find the most prominent ones. Okay, 1182, slightly higher, not much of a difference. So of course there are some other like minor support resistance in between these two levels. But all in all, this is gold and At this moment, market has sort of priced in a rate hike in December already. So if there is really a rate hike announced next week, gold price may not hit a lot lower. Of course, if during the FOMC next week, if the next rate hike guidance is not clear, or there is reason for the market to suspect the chances of a rate hike in the first half of 2017 is really low, then possibly gold may head back towards 1182. So for this week, there's not much of catalyst to move gold. The main thing is still US rate hike. So based on that assumption, I would expect gold to trade sideways manner for this week. So this is my expectation. So I can't find a possible decision region for gold, and because of the volatility, even if I find a possible decision region to tell me when to go long and short, chances is the risk reward for that trade will not be good. The stop loss will be wide, and then the potential target may be not so favorable. So that is my comment on gold. I do expect gold to be trading sideways at least for this week, but I can't find a decision point at this moment to tell me when to go long or short. So that's gold for me. The next request, yes, I see a lot of that coming up. Oil and dollar cat. Sure. Oil and dollar cat, let's go hand in hand. I'll just open the WTI oil and dollar cat. Okay, let's look at H1. So this is the current candle. So after the OPEC deal, price shot up, paused a while and shot up higher to $52. So prior to this afternoon, market is sort of still hovering below the $52 or 52.1. Okay, never mind, shift it higher. The resistance is about 52.2 since we are looking at a H1 time frame. Okay, 52.20 resistance, so market has broke higher, and sort of in the last 4 to 5 hours, market seems to pause there again. So just based on the deal last week, prices has gone up so much, so it's a lot. This shows that the expectation of the meeting is actually very low. So the market is not expecting a lot of things out from last week meeting. That's why, because the expectation is low, when they announce a deal as mentioned earlier on, it far exceeds expectation, and when it far exceeds expectation, market react more. So price is still going up. I have read some reports saying that WTI or oil may head towards the $60 a barrel. So at this moment, if you ask me, it's all about going long on oil, since it is in the direction, especially now price has broke higher. So let me zoom in a bit on candlestick formation now to refine the entry very short term. You will notice that for the last 5 hours, okay, prices failed to close beyond this level. Okay, if I streamline it, I just take the candlestick body to block out this decision region. So of course, if the price go below, it doesn't mean I will sell. I mean, it is fundamentals wise, I will remain sideline. If there's any short signal, I'll just be looking to go long for oil, at least for this week. So one way again over here, it is a breakout kind of trading, very short term. So that would be if it closes above, to make a decision to go higher, that would be a clue to go, a possible clue to go long for your consideration. And for this, you can possibly afford to put a aggressive, tight stop loss. Over there. So the advantage of having a tight stop is, once the price move a bit, you would have easily hit 1:1 risk reward, and you can consider protecting your position faster. So another advantage of tight stop, it will be easier to give a good risk reward ratio kind of trade, provided it moves in your direction, of course, because it is smaller. There again, everything has its pros and cons. The cons, of course, with a tight stop, market volatility could take out your trade first before moving in your direction. So this would be my suggestion for oil, very short term. And let's look at dollar CAD. Of course, dollar CAD, besides oil, that is affecting dollar CAD for this week, I think the Bank of Canada interest rate and their official statement is very important. So if they maintain an optimistic view, then possibly we could see dollar CAD breaking this support over here to go lower. $132.80. So if candle closes below, possible to go short. So for those of you who have read our weekly research, there is our picks. That means usually there are some charts that we pick and then put up, and we gave our bias on those charts as well. And one of it is actually the dollar CAD. So in the research we mentioned that we have a bearish bias on dollar CAD. So that was written in the morning, which is or rather noon time, which is about 9 hours ago. So 9 hours ago is about this candle over here. So from the point of us writing the article, the market has actually gone down a bit, about 30 pips. So at this point in time, on a H1 chart, if you want to go short, I think it's a bit risky. It's too near the support. So, and your stop loss is wide. So no point considering an entry on a H1 chart at this moment. But on a H4 chart, possibly for it to break the support before you go short. And for dollar CAD to break this support, we need two catalysts. One, oil prices has to go higher. The other possibility could be a hawkish Bank of Canada. So that could force the loonie to rally against the dollar. So that's dollar CAD for you. Oops. Okay, time flies. Let me just scan through the list of questions again. Can do a recap of today's charts. Okay, I think I'm running short of time to do a recap, but no worries. If you are a client of Fullerton Markets, you'll be able to access the recording of this webinar via our Fullerton suite. The webinar will be uploaded before midnight today. That means in less than 2 hours, it will be available on Fullerton suite. So instead of me doing a recap, what you can do, you can log on to Fullerton suite. If you can't sleep tonight, you can always listen to my webinar. I believe you can sleep after that. Or rather, you can wake up in the early morning before you go to work. You can just quickly scan through the last part of the charts as well. Okay, once again, we have come to the end of this week's webinar. So hopefully what I have shared will set you up nicely again for this week. So if you find this webinar beneficiary, please invite your friends to attend as well. This webinar is available to all. You can just ask your friend to go to Fullerton Markets website, go to Research and Education, and in Research Education, you will find the weekly webinar link to register for the weekly webinar. Alternatively, you can ask your friend to just like our Fullerton Markets Facebook page. We'll post up the weekly webinar reminder every Monday. So if you have a Facebook, you will get a reminder and you can just click the link to log into the webinar. So feel free to share this webinar with your friend. Ask them if you find that this will be good for them. Invite them to attend as well. So once again, we have come to the end and look forward to seeing you in next week's webinar. So this is Wayne signing off on behalf of Fullerton Markets. I thank you everyone. Good night and bye-bye.